Today, we will cover the many complexities surrounding multi-state taxation for small and medium-sized businesses. My name is Chad Cummings, and I am an attorney and a certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the law firm Cummings and Cummings Law. I also teach business law at Florida Gulf Coast University and hold 4 degrees, including 2 law degrees, together with a variety of tax, financial, and accounting credentials, which I apply for the benefit of my clients in my practice of law. Our firm website is www.cummings.law. First, as a threshold matter, let me dispel a widely held misperception of small and medium sized business owners. All too often, I speak with prospective clients who have erroneously been told by their CPA or bookkeeper that they only need to file taxes, which, by the way, may include sales taxes, payroll taxes, personal income taxes, business income taxes, excise taxes, and franchise taxes, just to name a few, in only their home state. And that is very often false. And to explain why, I must first explain the concept of nexus. But before I do that, let me give you a little bit of contextual background. My first job after grad school many years ago was preparing state and local tax returns for venture capital and private equity funds at PricewaterhouseCoopers, where I first gained exposure to multi-state taxation generally and the intricate concept of nexus specifically. While there, I prepared hundreds, if not thousands, of state and local tax returns, which provided me with experience that very few other attorneys and even few CPAs possess. The first and most consequential building block in multi state business taxation is nexus. And nexus is the legal threshold that determines whether a state may lawfully impose tax and filing obligations on your business. Many owners assume that the absence of a physical presence in a state shields that business from tax. That assumption is often incorrect. In addition to traditional physical presence, states adopt expansive economic nexus standards based on revenue, transaction counts, or other factor presence tests. Post the infamous Wayfair ruling by the Supreme Court, even modest sales into a state can trigger registration, tax, and compliance obligations, particularly, though not exclusively, for sales and use tax, but increasingly also for income, franchise, and gross receipts taxes as well. Complicating matters further, nexus may be established through activities that seem minor or inconsequential to business owners. A single remote employee, an occasional in person sales visit, the use of third party contractors in some cases, inventory held by a fulfillment provider, or even attendance at a trade show can inadvertently create nexus. Some states recognize click through or affiliate nexus, attributing the presence of related entities or marketing partners to your company. Other states apply factor presence nexus, where a specified dollar amount of property, payroll, or sales, or some combination of the three, triggers filing requirements. Each state's rules differ dramatically on thresholds, look back periods, trailing nexus after activities end, and the taxes implicated thereby. The convoluted result is that determining where you have a filing and payment obligation cannot be handled by a single rule of thumb. A fact specific state by state analysis is usually required and must be updated annually as thresholds and legal interpretations change. Misdiagnosing nexus leads to compounding liabilities, including uncollected sales taxes, penalties, and interest, which can become material very quickly. Therefore, a prudent approach involves formal nexus studies, written documentation and testing of assumptions, and periodic and ongoing reassessments prompted by operational changes such as hiring, new distribution channels, and market expansion. Sales and use tax rules represent the most visible front of multi-state tax compliance. After the Wayfair decision, every state with a sales tax adopted some version of economic nexus, often with thresholds tied to annual gross sales or transaction counts into the particular state. However, thresholds are not uniform. Calculation periods do vary, and measurement may include sales of services, digital goods, or exempt products depending on state definitions. Marketplace facilitator statutes introduce another layer of complexity, potentially relieving sellers of collection in some cases, but not others, and often only for transactions consummated through qualifying platforms. Businesses commonly underestimate the complexity of exemption management. Exemption certificates must be collected, validated, and retained according to the receiving state's specific requirements. A certificate that is perfectly valid in one jurisdiction may be wholly non-compliant in another because of missing language, expired dates, or scope. Drop shipment arrangements further intensify risk. Resale certificates from out of state purchasers are not universally accepted, and some states require the wholesaler to register to accept certificates from buyers. Furthermore, use tax liabilities may arise when vendors fail to collect tax on taxable purchases, and these often surface in audits. Effective compliance requires robust product taxability mapping, controls over tax determination in order workflows, and disciplined certificate management. Relying on assumptions such as software is never taxable or professional services are always exempt is dangerous. Many states tax specific digital deliverables or professional services, particularly those related to tangible personal property. Periodic reverse audits and reconciliations may help identify overpayments and underpayments alike, while documented taxability matrices and technological integrations reduce human errors and support audit defense. Once Nexus is established, business income and franchise tax obligations often hinge on a concept of apportionment, that is to say, the formula that divides your business's taxable base amongst the states. Modern regimes frequently use a single sales factor method, but that is not universal. Numerous jurisdictions still incorporate property and payroll factors, apply industry specific weights, or impose special sourcing for financial, transportation, and technology companies through a concept of allocation. Investors sometimes assume that a sale occurs when an invoice is generated and where the invoice is generated. That is not always true. In reality, states apply either market based sourcing or cost of performance rules for services and intangibles, and the distinction can dramatically shift liability. Throwback and throwout rules commonly surprise taxpayers. Under throwback, sales of tangible personal property shipped from state A to a customer in state B may be reassigned to state A's sales factor if the seller is not taxable in state B. This can occur even where public law protects the business from income tax in the destination state due to solicitation only activities. The interaction of these rules can meaningfully increase apportionment in the origin state. Conversely, some states apply throw out to remove certain sales from the denominator of the fraction, further skewing results. These mechanical attributes can create real double and, in some cases, even triple taxation exposure without careful and ongoing planning. An accurate apportionment outcome requires granular sales mapping, nexus determinations by customer state, documentation of where services are delivered or where the benefit is received, and attentive tracking of property and payroll movements. Moreover, conformity to federal taxable income rules varies widely, with different net operating loss rules, add backs, and credit limitations. Regular modeling using representative scenarios helps quantify the tax impact of market shifts or operational reorganizations before they occur, reducing surprises at return time. Public Law 86 272 offers limited immunity from net income tax for sellers of tangible personal property whose in state activities are strictly limited to solicitation only and are ancillary to solicitation. Business owners frequently overextend this protection, believing erroneously that it shelters all forms of in state activity. It does not apply to sales of services, licenses of software, digital products, or any activity beyond mere solicitation, such as installation, training, credit approvals, warranty service, or inventory maintenance. The line between protected and unprotected activities is a nuanced, fact intensive inquiry that is often tested in audits. Recent guidance from multi state tax authorities has attempted to modernize the interpretation in the era of online sales. States increasingly take the view that customer facing website features, post sale support, or mere data collection may, in certain cases, constitute unprotected in state business activity when conducted through devices owned by customers or third parties located within the geographic boundaries of the state. While positions vary and continue to develop, the practical takeaway here is that relying on antiquated assumptions about solicitation in the digital age is risky. Even if net income tax is shielded, other taxes such as gross receipts tax, franchise tax, sales tax, payroll taxes, and others may still apply. Prudent compliance requires a comprehensive catalog of in state activities, including post sale interactions, software functionality, and third party service arrangements. Contracts, marketing collateral, and support logs should be reviewed to identify potential unprotected conduct. If exposure exists, planning options may include restructuring workflows, clarifying vendor roles, or voluntarily registering to mitigate throwback exposure. The costs and benefits of asserting Public Law 86 272 should be evaluated alongside apportionment outcomes and the broader state tax footprint. Let's talk about pass-through entities. Partnerships and S corporations face a different multi-state tax calculus, particularly with respect to owner-level taxation. Many states require non-resident withholding on distributive shares allocated to out-of-state owners. Others mandate or permit composite returns, allowing the entity to file and pay tax on behalf of participating owners. These rules are highly technical and can differ for individuals versus corporate partners, residents of reciprocal states, tiered partnership structures, and publicly traded partnerships. Inadequate compliance tends to surface when owners file their own returns and discover under withheld amounts, thereby triggering penalties and interest. Another significant development is the widespread enactment of pass-through entity taxes designed to mitigate the federal, state, and local tax deduction cap. Eligibility, election procedures, credit mechanisms for resident owners, and interaction with existing withholding regimes vary materially by state. The timing of the election, the treatment of guaranteed payments, and the availability of credits to out of state owners introduce additional complexity, especially for multi tier structures. The risk of duplicative payments or stranded credits is genuine without coordinated planning. Comprehensive owner communications, annual election tracking, and schedule level reconciliation are indispensable. Agreements should address withholding responsibilities and consent to composite filings or PTE tax elections. Modeling the comparative impact of PTE taxes versus owner level filings helps determine the optimal approach. Documentation is critical as states scrutinize whether elections were validly made and whether credits are properly claimed across jurisdictions, particularly in years with ownership changes or entity reorganizations. The rise of remote and hybrid work creates multi state payroll obligations that are frequently and grievously misunderstood. A single employee performing services in a new state can trigger withholding, unemployment insurance, and other employment related taxes. Some states impose convenience of the employer rules that tax wages based on the employer's location unless specific conditions are met. Reciprocal agreements mitigate double withholding in certain cases, but the default expectation is that wages are sourced to the state where the services are actually performed, which is usually where the employee resides. Employers also face registration requirements that are independent of income, sales, or payroll tax nexus standards. Payroll filings, local occupational taxes, and workers' compensation rules can apply immediately when an employee begins working in a state. Payroll systems must consistently and properly assign work locations, and human resources policies must track work from anywhere arrangements that may change at any time. Errors commonly involve failing to register timely, misapplying or misconstruing reciprocity, or overlooking local city and county taxes that ride on top of and in addition to state regimes. To intelligently manage risk, organizations should implement formal remote work policies, collect employee location attestations, and coordinate with benefits and HR teams before approving new work sites. Geofencing tools, time tracking adjustments, and periodic address verification further reduce inadvertent noncompliance. Because payroll tax violations often cascade into income tax nexus and sales tax considerations, a cross functional review process helps ensure that an employment decision is not made in isolation or in a vacuum. While many business leaders focus on corporate or LLC income tax, which again may be taxed as a partnership or a corporation, that's a subject for another day and another video. Several jurisdictions impose gross receipts or margin-based taxes that apply even when a company is unprofitable. Think about that for a moment. These regimes often have lower nexus thresholds and can apply to out-of-state sellers based solely on sales into the state. The tax base definitions differ substantially. Some exclude certain pass-through receipts, others allow deductions for cost of goods sold or compensation, and many require industry-specific calculations and adjustments. Failure to register because, quote unquote, we did not make a profit is a common and costly mistake. Local taxes complicate the picture further. Major municipalities and even some small municipalities impose their own gross receipts or business taxes with separate registrations, allocation and apportionment rules, and return schedules. In addition, license fees, commercial rent taxes, and business privilege taxes and licenses can apply alongside state level obligations. Because these taxes often receive less attention during planning, they tend to surface late in the expansion process, resulting in rushed registrations and, in some cases, avoidable penalties. Therefore, companies should include gross receipts and local business taxes in their nexus analysis and forecast models. Careful review of product and service lines is essential to correctly compute the base, identify potential deductions, and avoid overstating or understating liability. Where available, voluntary disclosure programs can help limit look-back periods if and when exposure is identified. The financial statement impact can be significant, so coordination with accounting teams to accrue and disclose these tax liabilities accurately is prudent. Determining the correct filing group can be as important as determining whether to file at all. Many states require or allow combined reporting for what are known as unitary groups, while others rely on separate entity filings or alternative consolidated approaches. The choice may not be elective, and the definition of unitary hinges on complex tests of functional integration, centralized management, and economies of scale. Water's edge limitations may exclude certain foreign affiliates, and special rules apply to holding companies, finance entities, and captive insurance arrangements. Intercompany transactions invite special scrutiny. Numerous states require add-backs of related party interest or royalties unless narrow exceptions are met. Transfer pricing adjustments, while traditionally a federal issue, are increasingly asserted by states, especially when intangible assets or centralized service charges materially shift the tax base. The sourcing of intercompany service revenue and the treatment of management fees can significantly affect apportionment and tax base calculations. A defensible position entails a contemporary unitary analysis, documentation of intercompany pricing, and reconciliation of eliminations between book consolidations and state tax return documents. Proactive planning can include restructuring intercompany agreements to meet add-back exceptions, reviewing intangible ownership structures, and modeling the tax effect of alternative filing methodologies where the choice exists. These efforts reduce audit risk and improve predictability and defensibility in multi-state tax rate analysis. Let's talk about audit readiness for just a moment. State audits are a near certainty for businesses with material multi-state activity. Auditors often begin with sales and use tax due to the prevalence of documentation gaps. That is to say, that is the low-hanging fruit. Typical requests include detailed sales by ship to location records, tax determination logic documentation, exemption certificate files, fixed asset purchases, and use tax accrual reconciliations. For income and franchise taxes, examiners focus on apportionment schedules, nexus assumptions, intercompany transactions, and conformity adjustments. The quality and organization of records materially influence the scope, duration, and outcome of an audit. Statutes of limitation generally run from the filing date of a valid return. That is to say, if no return was ever filed, many states may assess indefinitely. Businesses that discover historical exposure frequently consider voluntary disclosure agreements, which can provide limited and capped look-back periods and amounts and penalty relief in exchange for timely and future compliance. However, the timing of contact, anonymity procedures, and negotiation of terms require careful handling by legal counsel to avoid triggering broader liability or jeopardizing eligibility for the program. An audit-ready posture includes documented taxability matrices, nexus studies, approval workflows for exemption certificates, and reconciliations that consistently tie returns to financial statements. Establishing a centralized calendar for registrations, renewals, and estimated payments reduces the risk of late filings. When exposure is identified, a structured remediation plan, prioritizing states by risk, implementing system fixes, and pursuing voluntary disclosure where appropriate and available, can halt compounding liabilities and demonstrate good faith to regulators. Now, effective state compliance depends upon reliable systems and data governance. That should be obvious, but it is a point worth emphasizing. Tax determination engines, exemption certificate management tools, and integrated expertise resource planning modules can dramatically improve accuracy, but only if they are configured correctly. Product catalogs must be mapped to tax codes with specificity, and jurisdictional rate updates must be applied promptly. Partial automation is common, yet gaps often persist around credit memos, drop shipments, marketplace transactions, and manual invoices, leading to inconsistent application. On the income tax side, data granularity drives apportionment integrity. That is what regulators like to see. Tracking sales by customer location and product or service type, property by situs and date in service, and payroll by work location allows for accurate factor computations. Inadequate or incomplete data can force the use of estimates or approximations that are difficult and in some cases impossible to defend. Workflow documentation around close processes, tax provision inputs, and return to provision reconciliations further supports accuracy and timely filings. A scalable approach includes periodic system audits to validate tax settings, cross-functional training so finance, sales, and operation teams understand tax triggers, and controls that flag significant changes, such as product lines or entry into additional states. Documented processes for onboarding remote employees, executing new sales channels, and contracting with third-party logistics providers and marketing partners help ensure that tax considerations are addressed proactively before changes are implemented. The overarching goal is to transform compliance from reactive cleanup to proactive risk management. Although multi-state taxation is complex, informed planning can reduce risk and improve outcomes. Businesses can evaluate the trade-offs between asserting PL 86-272 protection and accepting taxable presence to avoid throwback. They can analyze the benefits of single sales factor states when contemplating new facilities or workforce expansions. For pass-through entities, careful assessment of PTE tax elections relative to owner residency and credit mechanics can materially change after tax results. Strategic choices about fulfillment locations, inventory ownership, and marketplace arrangements can also influence nexus and apportionment. Common misconceptions, however, frequently derail otherwise sound strategies. Believing that selling only services eliminates sales tax risk ignores the reality of taxable digital goods and enumerated services. Assuming that a state without a corporate or business income tax presents no business tax exposure whatsoever overlooks gross receipts and franchise taxes. Relying on the old "we do not have an office there" tactic to avoid nexus fails in the face of remote employees, third-party inventory, and economic thresholds. Treating exemption certificates as a formality rather than as a precise legal instrument invites undesirable audit assessments that are expensive to remedy. The safest path forward involves disciplined fact gathering, periodic legal review, and ongoing modeling. As states change their rules, which happens all the time, as well as the change in interpretations and thresholds, what was compliant in the last reporting period may be deficient in the current reporting period. A coordinated approach to integrating tax, legal, finance, sales, HR, and IT ensures that decisions about markets, staffing, and operations reflect their full tax consequences and practical reality. Engaging experienced counsel to lead or review this process is not a luxury. It is a safeguard against persistent, compounding, and in many cases, embarrassing exposure. Initiating or upgrading your multi-state compliance program can be structured into manageable phases. Begin with a comprehensive nexus and exposure assessment across sales and use, income and franchise, payroll, and local taxes. Inventory all, let me say that again, inventory all in-state activities by jurisdiction, including remote workers, inventory locations, service delivery, and market channels. Evaluate economic nexus thresholds and consider the impact of marketplace facilitator rules. Concurrently, assess gross receipts, tax exposure, and local business tax requirements to avoid blind spots. Next, align systems and processes with your footprint. Map product and service taxability, configure tax engines, and implement an exemption certificate policy with clear collection and validation standards. On the income tax side, refine apportionment data, capture and establish clear documentation for sourcing methodologies. For pass-throughs, standardize owner communications, withholding protocols, and PTE tax decision-making. Establish a governance calendar for registrations, estimated payments, extensions, and returns with assigned accountability and escalation procedures. Finally, build sustainability. Start with the end in mind, as the expression goes. Schedule periodic reviews keyed to business events such as entering new states, launching products, or reorganizing entities. Implement audit readiness procedures, including maintaining a clean repository of support files, reconciliations, and documented policies. When historical exposure is identified, consider voluntary disclosure to control the look-back period and manage penalties. As your business evolves, treat multi-state tax compliance as a continuous compliance discipline rather than as an annual filing chore, and leverage professional guidance to keep pace with the ever-shifting rules and interpretations. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this video is general in nature and is not legal advice because legal advice, by definition, must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my earlier presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.